Welcome. In this video, we'll explore the essentials of companies, what they are, how they're formed, and why they matter in the world of business. A company is a legal entity, separate from its owners, created to conduct business and generate profit. This separation means the company itself owns assets, incurs liabilities, and can enter into contracts. As we move forward, you'll learn about the unique features that distinguish companies from other business forms, such as perpetual succession and limited liability. Let's begin our journey by understanding the core characteristics that make companies a powerful vehicle for business growth and investment. Companies have several defining characteristics. First, they are legal entities, meaning they exist independently of their owners. This allows for perpetual succession. The company continues to exist even if shareholders change. Ownership is divided among shareholders, who invest by buying shares. Management is typically handled by directors, who may or may not be shareholders themselves. Importantly, shareholders enjoy limited liability, meaning their personal assets are protected from company debts. These features make companies attractive for both entrepreneurs and investors. Next, we'll look at the different types of companies recognized by law. South Africa, the Companies Act 71 of 2008 recognizes several types of companies. The most common are private companies, TI Limited, which restrict share transfers and public offerings, and public companies limited, which can offer shares to the public. There are also state-owned companies, SOC Limited, personal liability companies, Inc., and nonprofit companies for public benefit. Each type serves different purposes and is governed by specific rules. Understanding these distinctions is crucial when deciding how to structure a business. Let's see how these types are visually represented and how they function in practice. Companies in South Africa operate within a robust legal framework. The Companies Act 71 of 2008 and its amendments set out the rules for company formation, operation, and dissolution. The Memorandum of Incorporation, MOI, is a key document that outlines how a company must operate, including the rights and responsibilities of shareholders and directors. The type of company and its public interest score determine the accounting standards to be applied, and whether financial statements must be audited or independently reviewed. This ensures transparency and accountability, protecting both investors and the public. Forming a company involves several steps. First, you choose a company name and define its goals. Then, you submit a notice of incorporation and the MOI to the Companies and Intellectual Property Commission, CIPC. Once registered, the company receives a certificate and gains legal rights. The MOI is crucial. It sets out the company's internal rules and cannot override the Companies Act. This process ensures that all companies start on a solid legal foundation, with clear guidelines for governance and shareholder protection. Next, we'll explore how companies raise capital and fund their operations. Companies need capital to operate and grow. They can raise funds by issuing shares to investors or by borrowing money through loans and debentures. The stock exchange plays a key role. In the primary market, companies issue new shares to raise capital, while in the secondary market, investors trade existing shares. This system allows companies to access large pools of capital and provides liquidity for investors. Understanding the difference between owners' funds, equity, and borrowed funds, debt, is essential for managing a company's finances effectively. Shares represent units of ownership in a company. Shareholders invest capital and, in return, gain rights such as voting, receiving dividends, and sharing in net assets upon liquidation. Companies can issue different classes of shares, like ordinary shares with voting rights and preference shares with fixed dividends. The MOI specifies the rights attached to each class. Shareholders can buy, sell, or transfer their shares, providing flexibility and investment opportunities. Next, we'll look at how companies issue shares and the accounting entries involved. When a company issues shares, it may offer them to the public or to existing shareholders through a rights issue. Public offers require a prospectus and may involve underwriters to guarantee the sale. Rights issues allow current shareholders to buy additional shares at a set price, maintaining their ownership percentage. The accounting for share issues involves recording cash received, allotting shares, and handling any refunds for oversubscription. Share issue costs are set off against equity, not treated as expenses. Understanding these processes is vital for accurate financial reporting. Companies can also raise funds by issuing debentures, long-term debt instruments offered to the public. Debentures are liabilities, not ownership interests, and pay interest at a specified rate. They can be issued at par, at a discount, or at a premium, and are redeemable at a future date. The accounting for debentures involves recognizing the liability, recording interest expense, and repaying principal at maturity. Using the effective interest rate method ensures accurate amortization of discounts or premiums. This approach helps companies manage their capital structure and meet long-term funding needs. Wrap up, companies are complex but powerful entities that drive economic growth. Understanding their legal structure, types, funding methods, and financial reporting is essential for anyone involved in business or finance. Whether you're an entrepreneur, investor, or student, mastering these concepts will help you make informed decisions and contribute to successful business ventures. Remember, companies thrive on clear governance, transparent accounting, and strategic capital management. Thanks for watching, and keep exploring the world of business.